Welcome to our Investors Minds. I'm Tai Hui, the Chief Market Strategist for Asia Pacific at JP Morgan Asset Management. And thank you for giving us a few minutes of your time to understand what investors are thinking about right now and how that fits in with building the right portfolio. Now, this is our final episode of the three that will discuss the market outlook for 2026. In this episode, we'll focus more on alternative assets as well as the overall asset allocation recommendations. I'm delighted to be joined by my colleague, Kerry Craig, who's our global market strategist based in Australia, who share with us a lot more on alternatives. So, Kerry, thanks for joining us.
Thanks, Ty. Great to be on the show.
So let's start with, private equities. I think there's been a lot of discussion on private equities over the past few years. And there's some clearly building concerns around excesses in this particular asset class. Is this a risk investors should be concerned about in 2026?
Yeah, I mean, that's a good question. There has been a lot of back and forth about what's happening in private equity. You had an increasing stock of dry powder, concerns around basically too much money, not being able to find an opportunity. There were concerns around valuations and how they hadn't been moving, as well as more detailed things around the age of companies that were being held to by the general partners because they couldn't perhaps offload them, as well as the use of continuation funds. All this did raise some of the concerns around the private equity market. And then obviously the volatility we saw in public equities earlier this year didn't really help the case. But I guess over the second part of the year, we've seen an increase in M&A activity, an increase in initial public offerings, and generally an increase in the exit activity in the private equity market, which has alleviated those concerns. And another big factor has obviously been the fall in interest rates in the US and the continued expectation of lower rates coming through, which does help in terms of thinking about the prospects in terms of the global and US economy, which supports economic revenues and corporate revenues, which is good for private equity companies. It supports the valuation argument, and also just means that you generally get a lift in the whole of the private equity infrastructure, if you will, that can feed through into other parts of the market as well. So I think that those continued changes we see will alleviate some of the concerns investors have had this year around private equity and present a better case for the outlook for next year.
Yeah, and just to extend to that discussion, what role do you think the private equity secondaries play in this environment?
Well, it's an increasing role. The secondary market was typically something that was very small compared to what we saw in the primary market. However, when the private equity market got gummed up there, when we didn't have a lot of exit activity, oddly enough, for an illiquid asset, a lot of investors were looking for liquidity. They were expecting to get back their investment they'd put forward so they could then reinvest it into other areas of private equity, and that wasn't happening. So they looked towards the secondary market, and that market has just continued to grow. So we've got, over the first half of the year, on an annualized basis, more than $200 billion in activity. And you compare that with what we saw in 2024, which was only $160 billion for the full year, it does see increasing activity in the secondary market, making it much more viable when thinking about providing that liquidity, both for general partners and investors through LPs, and thinking about how that becomes a way to reallocate across managers or just create another investment opportunity in the private equity market, because a lot of these deals come through at a discount to what you might see elsewhere, and you're actually mitigating some of that initial J-curve effect as you're entering into these deals a bit later in their life. So I think the secondary market's going to have growing importance and continue to grow in size, and we see it being something that's quite key to thinking about the underpinning the general operation of the private equity market next year.
Well, let's change direction towards the private credits, which has been attracting a lot of media attention in the past couple of months. Again, there's been some concerns with excesses in the private credit market, given the pace of growth and also some of the high-profile defaults recently. Have you seen some confidence loss with investors in private credits? And what does that mean for the outlook?
Yeah, I think that obviously the headlines we saw about those notable defaults within the US, some of the concerns that regulators have put forward around just how fast this asset class has grown, and maybe some of the exposures that are coming through for investors that maybe they don't fully understand, all things that are worth watching. However, I do think the private credit market has become, again, something that's of more interest to investors who are concerned around their allocations towards public fixed income when looking for ways to generate higher income in their portfolio. And you're getting that through private credit. Now, as that asset class is growing, obviously there's been a lot more competition for those lenders to go out to the market. That does raise the risk that maybe some of those underwriting standards have come down. and then maybe a little bit more chance of seeing an increase in defaults in the future. But I think it's important to recognize that those big headlines we saw that came through in the third quarter of this year around those companies in the US, that was actually the levered loan market, not the private credit market. Slightly different part of the private credit spectrum, sort of the hybrid between public and private. And again, if we look at the private credit market, you're still earning a pretty good spread over what you're getting on the cash rate or over what you can get on the levered loan market. It's still generating that income in a portfolio. However, it is important to be a little bit more diligent on the risk that's being undertaken. There are signs of some stresses coming through if we look at the increase in liability management exercises, which are effectively how lenders go through avoiding default by restructuring these contracts, or the increase in payment in kind, which is effectively not paying out those bond payments as they're due and adding them to the back of the loan. So that does indicate there may be some stress coming through. Again, like in the private equity market, as we see interest rates come down, that alleviates some of those pressures. But again, private credit, it has a floating rate component, so that may actually lower the yields as well. So I think overall, private credit, not a systemic risk. I think there's probably some things that are a bit more, require more due diligence by investors as they look at this asset class, but still a way to gain a lot better income in a portfolio as we consider the outlook for fixed income and public markets.
Yeah, so I think, if we look at our key theme for 2026, discipline is very much the core, the center of a lot of our considerations. And Kerry, as you rightly said, being disciplined about risk management, being disciplined about understanding the borrower's profile is really important in not just in terms of risk management, but also looking for new opportunities as well in order to generate the return. Okay, so artificial intelligence is a theme dominating investment portfolio, not only in 2025, but really expected to do the same in coming years. It's not just a public equity market story. How can investors broaden their exposure to this theme through uncorrelated alternative assets?
I mean, absolutely right, Tai. As we well know, this idea around the secular nature of AI is something that we very much believe in. There's questions around the valuations we're seeing in the public equity market, but I think when it comes to the private markets, when we think about the requirement for infrastructure build out to support this shift towards an economy more dependent on AI, you've seen some pretty hefty numbers come through when it's the expectations for the power generation required to support data centers. And the way they measure capacity in data centers is actually through looking at the gigawatts required to transfer them. And there is a huge increase in what we've seen in terms of that expectation as we've seen this increase in chip production come through. And so that does play through to thinking about how investors can actually, again, follow that same secular theme through infrastructure investments around power generation, as well as thinking about how you transfer that power in the grid, particularly in places like the US, where it's quite an aging infrastructure. And importantly, these asset classes are one that typically generate pretty steady incomes and cash flows. Because of that, they generally have low volatility in a portfolio. And because they're back to this secular theme, they're obviously uncorrelated with what we see in public markets as well. And so we would say that if you wanted to play that same secular theme through AI, but are looking for perhaps a lower volatility or uncorrelated way to do it, then the infrastructure market around data centers, around power supply, and around the grid are all viable options. I mean, those are long-term projects which require long-term capital, and giving up that money for some time does mean that you are getting compensated for it in terms of that cash return.
So just extend that discussion a little bit broader. If you look at our public market view for 2026, we're likely to see more volatilities because of more volatile growth and also more volatile policies. What alternative strategies look best placed to be able to take advantage of these volatilities?
I think one that's been something that's upcoming for a lot of investors has had some headwinds in the past is obviously around hedge fund strategies. I mean, these are the things that we look for to hedge that risk in their portfolio, given their name, but also do well when there's obviously a little bit more uncertainty and more volatility out there, where you don't have every different stock or market moving in the same direction. They need sort of that lower correlation between different stocks and sectors to play through. And they need that increase in dispersion and valuation as well. They're looking for that mispricing opportunity, whether it's in equities or fixed income. And so we do have a bit of a better recipe for thinking about how hedge funds could perform in this environment, as we have seen that dispersion and valuation start to widen out within the US equity market, how we've seen that correlation between the performance and stocks start to fall. And we're also thinking about, yes, while the cash rate is coming down, the hedge funds have a floating rate component, but we're not expecting that cash rate to go back to zero. So there's also some support from thinking about a slightly higher cash rate as well when it comes to hedge funds. So those three factors are really what we think about in terms of driving their performance, but also, again, the role they play in a portfolio, that sort of lower correlated nature with the public markets, the ability to take advantage of some of this volatility we expect to come through, and thinking about how they may fit through more broadly. So things like relative value, for example, as a hedge fund strategy will probably do quite well in this environment as we look forward to next year. But more broadly, we'll be looking at a way to play through a multitude of those different strategies and a relatively uncorrelated nature in a portfolio.
Great. I think obviously, as we've been arguing for quite some time, investors should really make a broader use of all the tools available to them in portfolio construction. I know, most people are familiar with equities or fixed income, but alternatives clearly play an increasingly important role in portfolio construction for a number of attributes that Kerry just shared with us, whether it's diversification or income generation or volatility management. So clearly, we do need to take advantage of these different tools. So just to summarize our overall asset allocation view, based on the macroeconomy, based on the public market and the private market alternative assets, I think there are a couple of things to watch out for. Number one, so the US economy is likely to avoid a hard landing, keeping the outlook for risk assets like equities and corporate bonds relatively constructive. However, after 3 years of strong market returns, valuations in areas such as US equities and high-yield corporate debt are relatively elevated and could be vulnerable to negative shocks. As a result, we do expect high volatilities in financial markets in 2026. Now, in the first half of the year, current earnings momentum and also the temporary boost to US growth based on tax rebates should continue to favor equities. But as economic momentum fades later in the year, investors may want to shift towards a more balanced allocation between stocks and bonds and alternatives. And of course, as I mentioned earlier, alternative income generating assets. Now, the key here is really about discipline, not just for investors, how they invest, but also the assets they invest in. So for example, fiscal discipline is going to come into focus for governments, political stalemates, or the lack of policy urgency to reduce deficits could prompt investors to demand a higher premium for longer dated government bonds or higher term premium, a trend already seen in markets like France and Japan. The outcome of the 2026 US midterm elections will also be closely watched for signals on deficit reduction. On the corporate side, technology companies, especially those involved in AI, will need to be disciplined in their capital spending and also how to raise funding. While demand for AI and computing power remains strong, growth may not be evenly distributed amongst all the major players. Careful company selection and attention to potential bottlenecks like power supply for data centers is going to be key. And also, financial institutions will need to stay disciplined in risk management, especially as deregulation continues under the current Trump administration. Weaker growth can lead to deterioration in credit quality, impacting earnings and capital base. Regulators are stress testing banks, but the resilience of non-bank financial institutions should also be closely monitored. Finally, in terms of portfolio construction for volatilities, with volatilities expected to rise, a disciplined portfolio construction is more important than ever. Diversification, income generation should be the fundamental principles for every investors, but this is particularly important in 2026. So, Kerry, thanks for joining us today.
Thanks, Tai. It's a pleasure.
And thank you also for joining us on this episode. If you found this useful, please share this with your friends and colleagues. And of course, consider subscribing. If you want to get our latest 2026 market outlook, you can visit our website or the Market Insights app. I'm Tai Hui. I'll see you in the next episode to discuss what's on investors' minds. Meanwhile, stay informed and stay invested.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions, and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase and Company and its affiliates worldwide.